Hello, this is Jim again for the Monopoly Project. We're doing one of our floating book reviews. We're on the Monopoly Project yacht. Every successful real estate investor has a yacht, and unfortunately it's the Bikini Girls' days off, so it's just me here on Val Vista Lakes. And today we're going to review this book called Fundamentals of Angel Investing. And it's about angel investing, as you would guess from the title. It's written by two guys, Hamilton Lord and Christopher Mirabili, who are founders of the of SeraphInvestors.com. It's a portfolio management for early stage investors. But more importantly, the Ham and Christopher actually have a lot of experience in doing deals themselves. So let's see, Ham's done 50 companies over the last 15 years, and Christopher's involved in 65. So they've been involved in angel investing through all phases of it, exits, good and bad, where they made money, where they lost money, where nothing came back. They are also served on the board of these companies. They served as advisors to the angel company and the angel CEO. So they're very, very experienced, and it's real experience. Again, it's not a couple guys who did it once or twice and then are selling books and data and information on just based on their non-existent experience. And I would like to point out, I'm just a baby angel. I've been in angel investing for 2 years now. I've invested $36,000 in 3 companies. It was originally $24,000 in the 3 companies, and then there were follow-on rounds for $12,000, so a total of $36,000. And of those, 2 are software-based related companies. One's a hardware-based company. So like I said, I'm just a baby investor, but I'm going to review their book based on what I think, whether this is a useful book for somebody who's interested in angel investing. And that's basically the answer. Is if you're interested in angel invested, or you're interested in getting involved in angel investing, or even if you're just curious about it, this is a really good book, because it's based on their angel course. Angel 101 is what they call it, and it's a basic introduction to angels. Now, on the other hand, I got to say, I'm not sure that angel investing is for everybody, because one, you have to be an accredited investor, which means that you have to have $1 million in wealth over and above your primary residence, or an income of $200,000 a year if you're single, $300,000 a year for a couple. So it isn't really for everybody. In fact, we're going to talk about in our opportunity option series of blogs, we're going to talk about replacing the angel investing with something that's more applicable. Because you need to be an accredited investor, that locks it out for most people. And in effect, you have to be you have to be rich, both in the sense of being an accredited investor, but you also have to be rich in the literal process, because to put up $100,000 or $200,000 to do angel investing means you have that kind of money. And so we'll talk a little more about that later. What I'm going to do is I'm going to step through the book and just make some comments on it. And then I'm going to add some comments to the author, because there's some few things in here that I think the authors could have did better to make this a better book. And not so much content, although there's 1 or 2 content related. It's primarily organization and how they present the information. So, and then I'm also going to do a shout out to our local angel group, the one I joined, Arizona Tech Investors, led by Jim Gulka, who's the chairman and lead, because that's another excellent. If you're in Phoenix, his information is as good as this, and you can see him in person either in the courses he teaches, which are basically, again, Angel 101, or if you actually join the group, you can visit as a visitor at the meetings, and that was interesting, and then you can join the group itself. So I'm going to start off by just some comments. And of course, in the book, the first question is, when somebody starts talking about angel investing, is, well, can I make money, and how many companies am I going to buy? And Ham and Christopher jump right into this on page 6 through 9. They answer the question of how many investments, and basically their answer is at the low end you should do 2 or 3 a year, and over a cycle that would lead to about 10 or 15 companies that would be in your portfolio at any time. And either they would fall out because they failed, or they would fall out because they were sold and you made money. At the high end, that's 7 to 10 companies a year, and that'll lead to a portfolio of about 30 to 50. Now I might point out that angel investing is a lot of work. It isn't passive investing like most real estate, where you might do a lot of work when you first buy the house, like Jeff and I just did, but then it sort of goes on cruise control. You do have to put a lot of diligence in it, and it's interesting, and I'll get to why it's interesting later. But of those 2 or 3 per year, 7 to 10 per year, they suggest putting in $10,000 to $25,000 in each one, and basically that's where I was. I was around the $10,000 or $12,000 for the 2, and then the third one I wanted to put more in, but it was oversubscribed, Oral Analytics. So I'm pretty much in line. And if you want to figure out how much money that actually takes to get into, fortunately, Ham calculates out those numbers on page 13. And if you go at the slowest rate, at the smallest amount of the smallest increment of capital, 10,000, you're talking about 80,000 for the first few years. And at the high end, it's 200,000 for the first year, 2 or 3, and even more if you want to go even higher than what he said. On page 15, he touches on crowdfunding. There's a lot of crowdfunding now, options in every asset class. Whether it's angel investing, whether it's real estate, whether it's basically anything that doesn't have a mutual fund can now be crowdfunded. And they point out that crowdfunding for angel investing, it isn't really angel investing. You're not doing the work, you're depending on somebody else. It's more like joining a venture capital fund, or a fund that invests in things. So and finally, the question everybody really asks, and the most important question is, well, how much money can I make? And there's one study that's always quoted, and they quote it in this book, and that is they calculate it in terms of IRR, and I don't like IRR as a calculation, and they even admit that it's somewhat confusing. It's basically your return taking into account how long it takes to get, which makes sense from a financial point of view, right? It's obvious that if you double your money in a year, you've made a really good investment. If you double your money in 100 years, that's a pretty bad investment. So IRR takes into account the time value of money. But the number that everybody quotes is 2.6 times the return of money in 3.5 years. This was based on a study of a lot of angel. So that comes out to an IRR of 27%. That's a good return, but it's not outstanding. I think you could do the same in real estate, and I haven't calculated that out. In fact, later in that chapter, Christopher says that his IRR up to now is 17%. But as he points out, it's probably going to go higher because he's already had some of the washouts that you normally get, most of the washouts, and he hasn't, the ones that he is making money on haven't sold yet, so he can't count them. So that's a good thing, because he's already through the bad exits. And then they go on page 20 to talk about psychic returns, and to me, this is the real reason why I'm involved in angel investing. Is there are other returns besides financial, and in his psychic returns he points out the ability to help other people, the entrepreneurs in the company, make their big idea come true, and being able to work with all these startup companies. And I agree with that, although I haven't had the experience that I haven't served on any review committees or doing any due diligence or all those things that entails. I've been asked a couple questions on 2 areas where I'm a subject matter expert, and those were fairly brief interactions with the people. But I would add to that to me, the real advantage is interacting with the other angels, because it's amazing when you go to these meetings and you might have 40 or 50 angels, and a team from the presenting company, usually the CEO and one or two others, and they would give their pitch on what their company's all about, what problem are they trying to solve, how big do they think the market is, who their competitors are, who does their team consist of, and finally, of course, what's their solution. And like I said, this can be software algorithms, this can be hardware, medical devices. One of the ones I'm involved in, onboard dynamics, is actually using an automobile engine to compress natural gas. So there's a lot of very interesting things. If you're interested in those kind of things, it's sort of like Shark Tank. Shark Tank is a very idealized view of angel investing, or early investing, whatever you want to call it, because things don't get resolved in half an hour, and they play out over 3, 5, even 7 years. And for medical type startups, it can go on longer because the FDA approval process takes so long. It's 10, 12 years. So to me, that's the biggest reward from the angel investing, and why I continue to do it. I've sort of fallen off because all the meetings are Zoom now, and I really can't stand Zoom meetings. But Jim's hopeful that we can get back together starting in April, so I'd really like to go back to some of the meetings and interacting with people and such. And then on page 21, again, if you're interested in angel investing, there's a fascinating discussion on how companies fail and how they succeed and how fast. He's got a timeline of angel companies and how they fall out on the bottom and how they grow on the top, and that's a very interesting thing. On page 35, he's got one of the few places where I actually disagree with what the author's saying. Again, I'm a baby angel, and they're super angels. They're like Michael or Gabriel in the Bible, the named angels. But they say the first thing they look at is a team, and I sort of disagree with that. And I'm going to, the reason why is, to me, the first question is there a problem to be solved? Because if there isn't a problem to be solved, you don't need a good team. You don't need the Manhattan Project team. You don't need the A team. You don't need the Justice League. If there's no problem to be solved, you don't need a team, no matter how qualified they are or aren't. And secondarily, even after you ask the question, is there a problem to be solved? Even if the answer is yes, the next question is the market big enough to make it worth this investment? Are you going to get their money back? And medical is a pretty good example of that, where you might have a disease or a condition which only affects a very few people, and so while it's a real problem, there's really no way to monetize it in a big way. I mean, it isn't that people shouldn't address those kind of things, and your technology or solution might be applicable for other medical conditions. But again, first you have to have a problem, and two, it has to be big enough so that you can actually make money in solving it, and then you go to the team. And I think at that point you go to the team, especially if you don't know what the problem is. You don't know if the team is qualified in that area. You might, obviously the different problems require different expertises in your team, and so then you look at the team, and obviously if they've had experience, that's good. If they've had successful experience where they actually started a company and brought it through to success, then that's even better. And then finally, fourth is the solution. Is what solution are they proposing, and is it technically sound, and so forth. So, and then after that, he's up to page 35, and the book's a lot, 100 plus pages, a little over 100 pages. So then they go into some fairly esoteric details of angel investing, the terms and the convertible notes and stock options, and control of, how do you maintain control, how do you maintain control on the board, and all these kind of things. So I'm not going to go into that detail, because this is more of a critique of the intro part of this. And finally, one more comment, as I would recommend, on page 104 they talk about opportunity cost, and how you should compare your angel investment returns to the other opportunities like stocks, bonds, real estate. And obviously in the Monopoly Project, I think that's very important. That's the central core of the Monopoly Project, is we're going to put a lot of money into real estate, but could we have made as much or more money with as much or less work in some of these other alternate investments? So I think they should move that up to the front, because it's a critical concept. So that was that's sort of my review of the book.